Gold doesn't have to win the war against the US dollar. Gold doesn't have to demolish the treasury markets like some gold bugs suggest. All it needs to do is return to mean. If it returns to mean, demand for this asset class increases fourfold. One can only guess what a fourfold increase in demand would do to a commodity where increases in supply are extremely limited. And that's precisely what I think is going to happen and continue to happen. I don't own gold because I think it might go from 2,700 to 3,000. I own gold because I'm afraid it's going to go to 9 or 10,000.
Recent U.S. data pointing to easing inflation has sparked speculation that the Federal Reserve may implement 2 rate cuts this year, boosting gold prices. The prospect of lower rates has further pressured U.S. Treasury bond yields and kept the U.S. dollar near a 1-week low. Markets now anticipate the Fed to deliver 37 basis points of rate cuts by year-end, up from the previous expectation of 31 basis points before the release of inflation data. At the same time, gold is traditionally viewed as a hedge against inflation. Higher interest rates tend to diminish its appeal as a non-yielding asset. Rick Rule, president and CEO of Rule Investment Media and co-founder of Battle Bank, suggests that gold could reach $9,000 to $10,000 as governments turn to inflation to manage their debt obligations. He also highlights undervalued sectors, including oil and gas, community banks, and wholesale insurance. According to Rule, this environment is ideal for gold to thrive, and he emphasized that gold has historically performed well under such conditions. The initial drop in dollar reserves starting on September 18th was driven by a reduction in the foreign repo pool. Following the November 6th presidential elections, foreign officials increased their pace of selling U.S. Treasuries. Since November 6th, approximately $78 billion worth of U.S. Treasuries have been sold, bringing total foreign official holdings below $2.87 trillion as of January 8th. According to data from the New York Federal Reserve, this marks the lowest level of foreign official U.S. Treasury holdings since March 2020, when Treasury markets experienced a freeze. Rick Rule pointed out that countries like China, which hold substantial reserves of U.S. Treasuries, find current returns increasingly unattractive, particularly when weighed against alternatives like investing in their own economies or purchasing gold. He emphasized that gold remains significantly under-owned relative to historical norms. Rule stressed that the compelling arithmetic, combined with evolving geopolitical dynamics, makes a strong case for the continued upward trajectory of gold prices. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
Thinking about the arithmetic in the context of why the gold price is rising. Gold prices usually rise when people are concerned about the maintenance of purchasing power in fiat currency denominated savings instruments. On a global basis, the world's reserve currency is the US, and by default, the world's preeminent savings instrument is the US 10-year Treasury. So let's look at the arithmetic just around the Treasury. The first thing to say is that the current deterioration of the purchasing power of the US dollars is measured conventionally by something called the CPI, the Consumer Price Index. And I would argue with you that the CPI is a very inefficient measure of the deterioration of the purchasing power of the US dollar. If you believe the CPI, it would suggest that the deterioration, Julia, of your savings is progressing along at about 2.6% per annum. I think if you examined your own personal finances in the period, say 2000 to 2025, a 5-year period, and you thought about how your health insurance premiums had changed, or how the price of your groceries had changed, or how, if you're a homeowner, mortgage interest rates have doubled, or if you're a renter, what has happened to your rents? When I run that same exercise myself, and by the way, I'm an old cheapskate who doesn't spend very much, I find that a deterioration of my purchasing power is more like 7.5% per annum than it is 2.6% per annum.
Mm-hmm.
I would urge your listeners to think about their own spending patterns and whether 2.6 represents the level of the deterioration of the purchasing power of their savings that they've experienced. If you use the CPI number, the arithmetic around the US 10-year Treasury isn't bad. You're getting paid 4.5% a year in a currency where your purchasing power is declining by 2.6%. which means you're getting almost 2% real yield. If by contrast you use the 7.5% number, that is, you're getting paid 4.5 in a currency that's depreciating by 7.5, you're losing 3% a year. The concept of investing in a riskless asset, a US 10-year Treasury, where your purchasing power declines by 3% a year, compounded over 10 years, is not very attractive. Let me restate that. It's extremely unattractive. And this is precisely the circumstance where gold does well.
Yeah.
And gold has done well.
Yes.
The second part of gold isn't so much arithmetic as narrative, which is to say the preeminent buyers of gold in the last 3.5 years haven't, in fact, been Americans concerned about the deterioration of their savings, but rather foreign governments who object to two things: the weaponization of the US dollar and the weaponization of the SWIFT banking system, which is to say the US government's attempt to use the US dollar to enforce its policy prerogatives elsewhere. Other countries object to that. And two, a return to that arithmetic. If you're China and you have $3 trillion in US treasuries, and you look at being paid 4.5% in a currency where the purchasing power is declining by 7.5%, it seems like a lousy deal, particularly when that's compared and contrasted with selling your U.S. treasuries and using the money to make investments in your own economy. The Chinese, of course, have done both, made investments in their own economy and bought gold. And I think what you're seeing there is the hegemony of the U.S. dollar challenged, often in favor of gold. One final piece of arithmetic, Julia, which we talked about 3 months ago, but some of your listeners won't have had the good sense to listen to us 3 months ago. That is this: gold is really, really, really underowned historically.
Financial market analysts are highly optimistic about gold's potential in 2025, with major financial institutions predicting significant price increases for the precious metal. This positive outlook is driven by the growing concern over the federal government's escalating debt, which has now surpassed $36 trillion. In addition, the U.S. government posted a record $711 billion deficit for the first 3 months of the 2025 fiscal year, according to the US Treasury Department. This marked the highest first-quarter deficit in history. The October to December 2024 deficit totaled $201 billion, a 39% increase compared to the $510 billion deficit during the same period in the previous year, as reported by Reuters. Rick Rule believes history offers a clear precedent, arguing that there is no viable way to address the growing debt other than inflating away its net present value, similar to what occurred in the 1970s. He suggests this scenario points to higher and significantly higher gold prices. Now let's redirect our attention to a video.
I don't own gold because I think it might go from 2,700 to 3,000. I own gold because I'm afraid it's going to go to 9 or 10,000.
Yeah.
Why do I say that? The last time that we had sustained deterioration in the purchasing power of the US dollar was the decade of the 1970s. In that period, 1970 to 1980, back to arithmetic, according to the Office of Management and Budget, the US dollar lost in excess of 75% of its purchasing power, which is to say, at the beginning of the decade, what was $1,000 worth of goods and services, by the end of the decade would have cost you $4,000 to buy. During that period, the gold price went from $35, admittedly a price-controlled $35, to $850, and I think passes prologue. I don't see any reason, any way, with the on-balance sheet liabilities of the U.S. government at $36 trillion, and with the government's estimate of the net present value of off-balance sheet liabilities, mostly entitlements, Medicare, Medicaid, Social Security, exceeding $100 trillion. That is to say, with net government debt over $130 trillion, I don't see any way out of this circumstance other than inflating away the net present value of those obligations, just like the decade of the 70s. And that means likely, not merely higher, but much higher gold prices. The decade of the 1970s and late 1960s was in many senses unpleasant. People on fixed incomes, people who relied on their Social Security, found themselves getting Social Security, but they found that their check every month bought less than it bought the month before. Savers took control of the interest rate market, people found that the interest rate paid on their first mortgages went from 5.5% to 17.5 or 18%. Pretty unpleasant. And people who owned long bonds got killed. Somebody who owned a really riskless instrument, which is to say a 30-year US Treasury, where their income was guaranteed for 30 years, found that the capitalized value of their 30-year bond in the decade 1970 to 1980 declined by 70%. So holders of long-term debt got massacred. People on fixed incomes got massacred. Salary earners, where their skill set didn't enable them to price their labor relative to the price of capital. That is to say, employees that didn't have skill sets that allowed them to raise their rates, also in terms of their purchasing power, got massacred. One consequence of that was massive social division in the United States. I'm not saying that we're going to see a return to domestic violence, but I'm not saying that we aren't either. When people are resentful and they're looking for a cause of their resentment, they very seldom look in the mirror. They most commonly look elsewhere. My hope is this. My hope is that my caution around debt and deficits is wrong. Hope is that the requirement for working people that they have contestable skills. I hope that's wrong. My hope is I'm wrong about the gold price. A $9,000 or $10,000 gold price implies a lot of things about the way other assets in society perform. It implies a real change in one's lifestyle. And my lifestyle's great. I would really, really, really like it if I was able to say, God, I got that one wrong. We got through it fine. The debt didn't matter. The deficits didn't matter. Contestability didn't matter. I just don't think that's the case.
The current economic environment suggests that gold is poised for a significant rise, driven by rising government debt, inflationary pressures, and the diminishing purchasing power of fiat currencies. As central banks and governments grapple with increasing financial obligations, the historical precedent of inflating away debt points to the possibility of much higher gold prices in the future. While some remain hopeful that the economic situation may improve without extreme outcomes, the ongoing fiscal challenges make a strong case for gold's role as a store of value. Do you think gold will continue to serve as a reliable hedge in the coming years? Your opinion matters. Drop your thoughts in the comments, hit the like button if you enjoyed this, and subscribe to stay informed on our journey together.